Buy low, sell high. There's a lot that's happening right now in the stock market with record high inflation in the last 40 years. You can buy Series I bonds that give you over a 7% return. Plus, World War III may start, and those kind of things always scare off investors and make the market far more volatile. And there's a lot that we aren't taught in school, but there's one thing that we do know, that you should buy low and sell high, and you make the most amount of money when you purchase a stock. So especially in today's market, you're wondering, when should I actually enter? When should I buy in? Where should I get the best position? And it's almost impossible to time the market, so you really shouldn't try. What's up, guys? It's Avery here. If you're new to the channel, typically I talk about personal finance as well as investing in real estate. And if you're new to investing and investing in the stock market and you want to learn about how you should go ahead and buy those stocks, go ahead, stick through the end of the video, and I can talk about some great fundamental strategies to allow you to win in this market and in every single market. So if that sounds cool to you, make sure you stick around and go ahead, scroll down, and give this video a like so we can get started. Timing the market is near impossible, but you may hear otherwise from day traders who are trying to sell you their course via social media because they've gone ahead and rented a Lamborghini and maybe won big on one stock, and that's exactly what they're showing you. But a majority of day traders out there, people who are looking at the stock market all hours of the day that it is open, and they are buying and selling constantly, they may have some big wins, but more often than not, over the course of the entire time that they're trying to actively trade, they will lose money. A majority of studies show this, that almost 95% of people who attempt to beat out the regular market interest return that you can get often lose all their money and do far worse than those who just invest for the long term. There was also a very cool study that looked over if you attempted to time the market between January 1st, 1999 and December 31st, 2018, in which we saw a couple of different recessions and there wasn't just a bunch of big gains. So it actually is a good time period for a study that showed if you missed out on the 10 best trading days, that you would have half the amount of gains than someone who just left their money in the stock market the entire time. That's 7,304 days. So 10 days is only 0.14% of the entire days that you have had to have had your money out of the market in order to lose half the gains. So really, it is very difficult to time the market, and I would implore you to just invest for the long term and get the regular rates of return that you can in the stock market and invest very passively. So when we're looking in this market, we may be thinking day trading looks very cool. People are out there showing that they make lots of money, that they're dropping out of college, that they're living their best lives possible, that they're able to sell you their course, and that's how they're actually making their money, and they're not actually making it through day trading. But I really think that the absolute best way and best way to buy in this specific market is to just buy all the time. So at day trading, you're giving away a lot of your time looking at various data points, analyzing charts, and basically anything else in order to lose all of your money. But instead, you could invest very passively for the long term if you just follow some type of index or ETF that follows the entirety of the stock market. That way you do not have to think, you keep all of that time, as well as you're going to be continuing to buy into good positions wherever you may be in the stock market. And I really believe that that's the best way to do it. And there's a common saying that time in the market is always better than timing the market, but I think there is a little bit of a caveat to that. You cannot just buy anything, leave it in, and expect it to go up. I have three good examples here of this. The first one would be GE, or General Electric, and this was a very common stock that people often purchased throughout the years. It was a very good blue chip company that eventually lost a lot of value. At one point, it had a $1,408 per share price, which was very good, and people continued to buy into it. And if you just held on to it for a really, really long time, like you might would with an index, and you feel like it's gonna go up and up and up because you're betting on the entire US economy, but in this case, you were just betting on General Electric. And today, their share price is around $100, which is obviously a lot less than $1,408. And if you just kept that money in the market there for the entire time, where you're just keeping your money in because you have time in the market versus timing the market, you would still do poorly. So you still have to make good decisions on what you are actually attempting to buy, and you can't just buy anything in the market and expect it to go up or continue to go up. Other examples of this that we can take outside of the market could be for real estate. Often people will say real estate will appreciate at 3% per year. It's gone up a lot more in the last couple of years, and in some places it's gone up way more than that over the course of the entirety of that place being a place, like Manhattan or Boston or Los Angeles, some of these other coastal coastal cities have a lot of appreciation compared to some type of Midwestern market. These Midwestern markets still get that appreciation, but there are certain cases where just because you bought real estate does not mean it'll go up. For example, if you bought in a military base, a town that basically the entire sector was a military base, and then that military base moved, that town would no longer be a good place to own property. So if you hear of the military base going away, you may also want to get rid of your real estate because you know that this town is probably not the best place to own property anymore because all of your renters or all of the people who had demand to buy homes are no longer going to be there. And another thing might be a rural area. Maybe you can get really inexpensive real estate, but it's really inexpensive because there is low demand. If you were to buy in downtown Manhattan, even today, even though the prices are extremely high, there will always be demand for people to want to live in downtown Manhattan unless we have some type of apocalypse or something drastically changes with the world. But more often than not, people will want to buy that property that you own in downtown Manhattan because people are always moving to New York City and people will always want to be there. So bring that last example back to the stock market. If you can purchase an ETF or index fund like VTI, VOO, and SPY, which make sure you do your own research before you purchase these things, but they follow the entirety of the US stock market, then you're probably going to be doing just fine over the course of your life. Just like if you bought in downtown Manhattan, it may be expensive, it may be the place that you can't afford right now, and it may look cheaper to buy in that rural area or that place that is up and coming, but those places may die down and you are gonna have to do more research, watch it more, and make sure that you actually get in and out at the right time. But if you're buying those blue chip stocks, those ETFs that we feel good about because the US economy is going to increase, then you're probably going to do pretty well. There's a lot of innovation, entrepreneurship, and companies that move to the US that make the economy grow. And if you are just purchasing stocks all the time that have to do with the US economy, then you can feel pretty good about whatever position you buy in today's market, tomorrow's market, or any market that you might view over your lifetime. So hopefully you guys enjoyed that video. Let me know what your strategy is when it comes to purchasing stocks and what type of funds or stocks specifically that you actually like to buy, or if you have different investment strategies and you don't like investing in the stock market at all. Personally, I really like investing in real estate and I think it's one of the best investment vehicles, but I also invest in the stock market because it's highly passive and very easy to do. And like I've said throughout this entire video, I feel strongly about the US economy increasing over my lifetime. So if you guys like that video, make sure you hit that subscribe button for more personal finance and real estate investing content, and hit that like button if you haven't done so, and the notification bell so you don't miss out when I make videos like these. And if you like me here, don't forget to check me out on TikTok as well as Instagram. I make similar videos but in short form. So thanks again for watching, and more wealth is coming your way.